If you've been holding your breath for mortgage rates to drop back to 3%, it is time to exhale. Those rates are history. This line shows our path. After pandemic lows and a sharp spike above 7%, rates are leveling out near 6%. This stability triggers the lock-in thaw. Homeowners are finally moving, causing regional inventory to climb by over 16%. That wave of new listings is beginning to break the market paralysis, shifting us away from total gridlock and into a more active environment. But more options don't automatically mean an easy path. With inventory rising while borrowing costs hold firm at 6%, many are wondering if it's safe to act now or if the current conditions favor those who wait. The old strategy of waiting for lower rates now carries a significant trade-off. As the wait-and-see window expires, the potential cost of waiting another year can outweigh any minor drop in interest rates. It's a transition from a market of scarcity to one of choice, but that choice comes with the reality of higher baseline monthly costs. This market is also highly fragmented. The leverage you have depends entirely on the specific county you're in and the type of property you want to buy. Success in 2026 means looking past the national headlines and focusing on how these local shifts actually align with your personal financial math. The biggest advantage for buyers right now is time. Average days on market have stretched past 60 days, giving you the room to negotiate that simply didn't exist 2 years ago. This chart maps where that leverage actually lives. Down here in the high-cost, low-leverage corner, urban cores like Mecklenburg County and the city of Charlotte remain tight, with less than 3 months of supply. Securing a resilient asset here means a seller-leaning environment with steady competition. Now look at the opposite corner. In outlying counties and attached housing, like condos and townhomes, inventory has jumped by 17%. Buyers looking in these markets are finding a much more balanced environment, with over 4 months of supply in some outlying areas. Here you can avoid bidding wars and negotiate seller concessions, like a 2-1 rate buy-down. Finally, coastal and retirement markets operate in their own quadrant, driven largely by inbound migration and cash buyers. Because these micro-markets are less sensitive to the 6% rate environment, property values tend to stay stable, even when national lending trends fluctuate. Essentially, the health of the market depends on your willingness to shift your search toward the areas where buyers currently have the most leverage. While everyone talks about the 6% rate, focusing on that number alone can hide the actual cost of your monthly payment. We are seeing home values remain resilient. In the first quarter of 2026, median sales prices climbed toward $399,000, while average prices in some regions crossed the $500,000 mark. As home values rise, so does the tax and escrow requirement, sitting right on top of your principal and interest. In Mecklenburg County, a tax rate of 49.27 cents per $100 of value adds nearly $2,000 annually to a $400,000 home. Lenders collect 1/12 of this estimated annual tax every month in an escrow account, ensuring the county is paid directly when the bill is due. You also have to watch for supplemental tax bills. If you buy new construction or finish a major renovation, the county will reassess the value, which can trigger an unexpected mid-year bill. While these taxes increase your monthly burden, they also fund the schools and infrastructure that support your home's long-term value. The bottom line is that true affordability is the sum of a 6% mortgage rate and these local tax rates. It means the financial bar to enter the market is higher today than the headlines suggest. Because the market is varied, there is no universal right time. Let's look at 3 profiles. First, the locked-in upgrader. You sell for the space you need, taking advantage of growing inventory. The trade-off is losing a low rate. Many use equity to buy down their new rate or reduce principal. Second, the first-time buyer. Your strategy is pivoting towards condos or townhomes where inventory is higher. You may compromise on a standalone yard, but it allows you to build equity now rather than wait. Finally, the cash buyer. Your strategy targets premium coastal properties while others are sidelined by costs. You aren't affected by a 6% rate, but you are buying at peak prices. Success depends on long-term migration trends. In any case, the risk of waiting too long is real. Inaction has a cost. Don't let the memory of 3% rates stop you from moving forward. Identify your scenario, look closely at the local math, and make your move with confidence.